Hello accounts people, back to our DAIF walkthrough. We're going to have a look at the consolidated using the same practice paper, which has lots of adjustments and a couple of variations on the theme that I can show you. The only thing it hasn't got is the unrealised profits in it. So this is where an intercompany transaction is still in stock, and so I'll do some other work on that later. So we have the two financial positions. The question doesn't tell us that to the acquisition date of the first. These are full financial position. You may see an extract, in which case the investment would probably be in the text. You may also see totals of current assets and totals of current liabilities in both the extract and in the actual answers, where you just got to add everything together. You've got to remember that the retained earnings are the end of the year, and we have got to have a note further down that tells us. So tax liability, everything else is fairly routine. So generally speaking, in the last year I've come across quite a few students struggling, and I've helped them. It's been my job to help them. I have been paid to do so, and what I've done is get them to do the easiest numbers first, because they were lacking in confidence. Somebody had taught them but they hadn't got it, and they were failing or had failed the exam as a result, or done badly. So pick out the ones that are easiest and then increase the difficulty. So I'm going to do it in that order. I will, however, make a couple of notes. That's 80%. How do we know it's 80%? 8 million shares, they're £1 each, there's 10 million of them, not to be confused with the 2 million in share premium, which is there to tempt you. This, we're going to assume, is the acquisition. Even though it doesn't tell us in the question, we know it's got to be, really, so that one. And then we've got a revaluation here, awkward numbers, might as well do it now. It's going to come in a few places. It's 1.5 million revaluation of something owned by the subsidiary. This one, you can't owe yourself money or be owed by yourself. So receivables and payables, it's just like shifting money from your left pocket to your right pocket. You're no wealthy, and it doesn't really count to your overall wealth. So this one is just payables. If it was an intercompany loan, we would be taking that off the liabilities and the assets as well, wherever, depending on whether it's current or non-current. Impaired goodwill, that's part of the calculation, one of the variations. You may not get goodwill impaired. And then AAT stick to proportionate share of net assets as a way of calculating goodwill. So let's get on with it. Something easy to start off with. Now this is the full version. There's a couple of things here. Okay, some of these drop down boxes here you might have to put in, but there are lots of numbers that you're just going to add together. Legally they are two separate limited companies. Their tax bill is independent of each other. So we can do this one to start off with. First number, first marks. What else can we do that's just added together? Well, the inventory in this case, this wouldn't be the case if there was some goods sold from one to the other still in stock, but we just have to reduce the value, we just have to adjust. So we'd just be taking that one off, and I can't think of any reason why cash and equivalents would ever need anything other than the two added together, except for one being in the current liabilities, meaning they're overdrawn. So those are just the two added together. Everything else so far, that's adjustments, adjustments, adjustments. And non-current liabilities, it isn't any intercompany loan, so they both got loans. We're just going to add the two together. So far, so good. Everything, some marks earned, and all we've done is add things together. So the next couple of items are just knowledge. Share capital is always just a parent only. So and so will the share premium be. Just the two added together. So adjustment, 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 and no adjustment needed there. So we'll do this one next. So the non-controlling interest, this is in the equity, so we're interested in the 20% that is still owned by somebody else, the segment of the subsidiary that is somebody else's. Sometimes I do it visually and draw it out as a segment on the board. So the non-controlling interest, so we know it's 20%. That's okay. We've just got to make sure we don't get confused with the retained earnings at acquisition, which does happen. So we're going to take the shares, they still own 20% of that, and the premium, and they get their 20% of the revaluation. It was their asset that has gone up, they own a fifth of it, and we need the end of year figure. So 10, 12, 20, might as well just do it as a sum. Just to recap, share, one of the more commonly incorrect numbers, especially if there was unrealised profits, particularly if it was subsidiary selling to parent, they take their hit on the unrealised profits. If it's parent to subsidiary, there's no adjustment to the non-controlling interest, but we'll worry about that later. So now we've got a couple of numbers that will just need a little bit of adjustment. So property, plant and equipment's one of them. This one's got its own workings out box, and the current version isn't the two, well, it is the two added together, however you don't see it as two separate rows in the latest versions. Prior to adjustment, the two added together, and then we've already worked out the revaluation, because that's what it actually means. It's the revaluation, and that's 73,900, and we're starting to get almost met level with enough numbers in there. And we can meet if we get the next couple right. So the receivables, you can't owe yourself money, but we know how much it is. It's in the text. It's 200, or we're going to type in 200. It's 200,000, but of course it's already in thousands here. So golden plus mile minus 200. We are 13,400. So in the variations that you'll see, including the AAT practice papers, 20,900, if I put it here, you may just get a workings out box, you may not, and you just end up with the wrong row to put the total of current assets in. And exactly the same will happen with the current liabilities. We've got the tax liability in there already. However, trade payables, same rule, add the two together, but we can't count the 200. So can't owe yourself money, can't be owed by yourself money. So there we are, 16,300 plus 3 zeros. So again, the same idea. You may find, or you will see in one of the AAT practice papers, just a single row for the total of current liabilities. And we're starting to get through our paper. We've now got to met level. We have enough numbers in there. If we did get the other numbers wrong, retained earnings has got a workings out box, goodwill's got a workings out box, we would just lose marks for what we've got. But we'd better finish it off, and we better do the goodwill. So this one is the version. Two versions, one of which subtotals the acquisition and doesn't. So consideration is the amount paid. That was our number, wasn't in the text, wasn't clearly said. It's the investment in Mile Limited. Again, I think most students by the time they get to the exam never learnt that one. And then the net assets acquired will be the whole amount. However, let's get it right. This is at acquisition, so it may say net assets acquired, it may say net assets acquired at acquisition, but we assume when you acquire it is at acquisition. Different versions, and what they got was the 10,000. We know that, and we know about the 2. We've used this before, the premium. And we know the revaluation. However, we've got to remember it's the retained earnings at acquisition. So if I type that out again, easy to make mistakes here. $90,900. I'm not sure whether you lose marks, but well, you don't get marks for the working out boxes by themselves. So if you left that in as a positive, it wouldn't be a disaster. But obviously, you need to remember to take it off when you work out the sum. And then the non-controlling interest again. Are we dealing here at acquisition? Yes, because. So it may say non-controlling interest, could also say that one, it could give the percentage or something else. So actually it's now just the 20%. Don't mind doing this slowly. Share capital, premium. Retained earnings at acquisition 3,980. So slight variation. Again, enough practice papers, you'll see this. If we subtotal that one, we have got goodwill at acquisition 4,080, and then we need to impair it and it's 15%. $612. So the goodwill in the accounts, in this case 3468. So one of the commonly incorrect figures. We've got 77368, which means we can do our total assets, the non-current and the current. 98268 will be our balancing figure. So what have we got left? We have our retained earnings calculation to do. So this one's relatively easy, simply because there isn't the unrealised profits. That would make it more complicated, and if it's subsidiary to parent, or this is possibly the most common incorrect figure. However, we haven't got the unrealised profit, so this is relatively easy. Okay, let's go for it then. So first of all, parents. That's okay. Retained earnings. Where do we get that one from? It's there, 7,500. Could have just done equals and gone up to it. Then, doesn't matter what order you do it in. Easy to forget, easy to miss out. And then we've got to work out how much they get from the subsidiary. Well, they've only owned them in the last year, so mile limited free post acquisition profits. Who did that one? Free post. Okay. Post acquisition profits attributable. Just to try and catch you out. So, okay, this is the first sum. We know it's at the moment, and it was when they bought them. So they've made 1.6 times, and they are the parent company. So this time it's 80%. 12.80. So of course they only get their share of the profits since they bought them. The profits before they bought was part of the goodwill, part of the calculations. So 8168 retained earnings. Now for the truth, stick that in, add up the equity. There we are, 5468. Subtotal of the liabilities. Just looking for that number. How have we got that number? Just the two added together, that's better. I'm not sure what happened then. Now the truth, equity. Okay, it's really messing me up. I'm going to do this. Equity plus 98,268. There we are, 92,668 total assets and equity and liabilities. Were you wrong? See if you can work it out. Don't waste time. You may have only dropped a half a mark, something on the retained earnings or something of that nature, or you might have made a typo. Get on with the other two tasks. So following this, you've got the easiest task, the ratios, as long as you bother to learn them, and then interpretation, where you need to make sure you earn the marks. But you can always come back to this once you've done that and see from your workings out and notes you've made any errors. But by and large, if it balances, fine. Tick, go, move, use the time wisely.